Let's talk about investing, specifically global funds. These funds let you own a piece of the world's biggest companies, from tech in America to manufacturing in Asia. But access comes with a price tag. Every fund has costs, and you need to know what you're paying for. The most common cost, the expense ratio, an annual management fee, a percentage of your investment. For a low-cost index fund, this fee is tiny, maybe 0.1% or 0.2% a year. On $10,000, that's just $10 or $20. But actively managed global funds can charge 1% or more, $100 or $150 a year on the same amount. Over decades, that difference adds up to thousands of dollars lost to fees. So, the first step for any smart investor: know the numbers. Before you invest, check the expense ratio. Understand what you're paying for the privilege of investing. This isn't about being cheap, it's about being smart. Make sure every dollar you invest is working as hard as possible for you. Nobody will care more about your money than you do. Be your own financial advocate. Don't ignore the costs, they matter. Let's make your money work for you, not just the fund company. Some funds cost a lot more than others. Is the extra cost worth it? The answer: sometimes yes, often no. If you pay a premium, you should get premium results. High-fee funds claim you're paying for expertise, a manager and analysts who find opportunities computers might miss. But talk is cheap. The proof is in the numbers. TrustNet's analysis found many expensive funds fail to beat cheaper ones over time. After high fees, their performance is often average or worse. Paying more doesn't guarantee better results. However, a small group of expensive funds do justify their costs. They consistently outperform even after fees. These are the superstars. Our job as investors isn't to avoid all expensive funds, but to identify the rare few that are truly worth it. That's the key to building real wealth. It takes homework, but the payoff can be huge. Don't settle for high fees without high value. Demand proof, not promises. That's how you invest smart. Let's look at a real example. FundSmith Equity Fund, managed by Terry Smith. This fund charges a higher fee than a basic tracker fund. But what do investors get for that fee? FundSmith's strategy is simple: buy great companies, don't overpay, and hold them. No chasing trends, just discipline and deep understanding. Over the last decade, FundSmith has beaten the average global market index, even after fees. Investors here saw their wealth grow faster than in a basic tracker. This is a case where paying for expertise paid off. When a fund consistently beats the market, the fee becomes an investment in skill. Of course, past performance isn't a guarantee, but a long history of success signals a sound strategy and a skilled team. That's the gold standard. This is a fund that would be approved. Now, let's talk about the low-cost champions. Global Index Tracker Funds. Take the Vanguard FTSE Global All-Cap Index Fund. No star manager, just a simple strategy. Own a piece of nearly every public company worldwide. The big advantage? Cost. Expense ratios are fractions of a percent. More of your money stays invested, compounding over time. The performance is average by definition, but average is a high bar. Most expensive funds fail to beat this simple, low-cost option over the long run. For many, a global index fund is the smartest, simplest way to invest. It's diversified, transparent, and incredibly cheap. No worries about manager turnover. you're betting on the world's long-term growth. For a set-it-and-forget-it approach, this is a powerful choice. Compounding and low fees work in your favor. So, what makes a high-fee fund worth it? First, long-term outperformance, over 5, 10, even 15 years. Consistency is rare and signals true skill. Next, a clear, repeatable investment philosophy. If you can't understand the strategy, move on. Look for high, active share. The fund should be truly different from the index, not a closet tracker. Finally, check the management team's stability. The skill you're paying for is often tied to specific people. If the star manager leaves, reconsider. Only pay up for a proven, disciplined team with a real track record. That's what justifies a higher price tag. Growing your money is great, but protecting it from big losses is just as important. This is where top-tier active funds can shine. A skilled manager's job is to lose less when markets fall. If the market drops 30% and your fund drops only 15%, you're in a stronger position. This helps you stay invested and avoid panic selling. Good managers act as shock absorbers, smoothing out the ride. They can move assets to cash or focus on defensive businesses, companies people need, no matter the economy. Investing in strong, resilient companies is risk management. Funds like Fundsmith, with quality global brands, have held up better in downturns. That's not luck. It's disciplined, risk-aware investing. Many are willing to pay extra for that steady hand. Index funds can't offer this kind of downside protection. Sometimes paying for skill is worth it. Past performance isn't a guarantee of future results. Don't just look at the numbers. Understand the story behind them. Did a fund succeed because of a one-time trend or a timeless strategy? Look for funds that perform well in both good and bad markets. True skill shows up in tough times, not just bull markets. TrustNet's findings remind us most expensive funds aren't worth it, but the best have something special. Do your homework. Don't chase last year's winners. Find funds with consistent, risk-adjusted returns and a strategy you understand. That's how you invest with confidence. So, what does this mean for you? You're the CEO of your financial life. Choose your strategy wisely. If you want simplicity, a low-cost global index fund is a fantastic choice. It's hands-off, diversified, and reliable for the long term. If you're willing to research, consider adding a top-tier active fund for a portion of your portfolio. Don't put all your eggs in one basket. Balance is key. The important thing is making informed choices. Question fees, compare options, and demand value. Whether you go simple or add a superstar, act from knowledge and strength. That's the foundation of financial success. So, are expensive global funds worth it? For most, the answer is no. Denied. High fees and mediocre performance are a bad deal. A simple, cheap global index fund will serve you better than most expensive funds. But for a rare few with a clear strategy, disciplined management, and a history of outperformance, the answer is different. Approved. These funds have earned their higher fee by delivering real value. Your default should be low-cost index funds, the foundation of your portfolio. Only add a high-performing active fund if you've done your homework. Think of it as a turbocharger, not the engine. The power is in your hands. Investing isn't too complicated. You just need to know what you own, what you're paying, and demand value. Build a strong, resilient portfolio. Take control of your financial destiny. You have been approved.